Welcome everybody to the third episode in the 2021 Americas FIXinar series. This episode is kindly sponsored by Outsource Trading. Before we hand over to our panel, just a few housekeeping bits. This is governed by Chatham House ruling, meaning quote checking policy will be in place. If you would like to quote any of our speakers, please contact the FIX Programme Office. If you have a question throughout, please use the chat function at the bottom of your screen or raise your hand and we will unmute you and you can ask a question live to the panel. I'd like to hand over to our moderator now, Nick Cox.
Thank you very much for that introduction. Just waiting for my panelists to switch themselves on. Just to give everybody a bit of an introduction onto myself, my name is Nick Cox. I've spent most of my career trading foreign exchange and fixed income markets on the sort of buy side and sell side, latterly running fixed income trading for BlackRock and then JP Morgan Asset Management. And currently I'm working, supporting a number of smaller businesses, fintechs and so on, as they try to sort of navigate how they can help the buy side solve some of their trading challenges. And looks like my esteemed panel with me now. So guys, could you maybe sort of introduce yourselves and give a brief summary of sort of what you do and your reason for engagement here? Miguel, maybe starting with you.
Sure, thanks Nick. Thanks for having me. My name is Miguel Cota. I'm a Vice President and Senior Fixed Income Trader for American Century Investments, and my focus is across fixed income assets, so credit derivatives, munis, supras, sovereigns agencies, and futures. Anyway, I'm here just to kind of share my thoughts and knowledge around protocol and fixed income trading best practices. That's it. Thank you.
Thanks, Miguel. And I guess John.
So my name is John George. So I run fixed income, commodities and currencies trading solutions at the London Stock Exchange Group. So very excited to be here.
Thanks, John. And Bill? Do we have Bill? Yes, we have Bill.
A year later, I'm still figuring out Zoom. My apologies to everyone. My name is Bill Hayden. I'm Managing Director at TradeWeb, where I run the fixed integration team.
Great, thanks. And then last and absolutely by no means least, as they are our sponsor, Mark.
Thanks, Nick, and hi, everybody. Pleased to be here. I'm Mark Waters. I'm a co-founder and a director at Outsource Trading. We're a specialist fixed income trading technology provider, giving solutions to the buy side, the sell side, and intermediaries to streamline and improve their fixed income trading capability as markets electronify. My background is in fixed income e-trading, of course. Pleased to be here. Thanks, Nick.
Thanks very much, guys. I mean, I think that sort of demonstrates the sort of depth and breadth of expertise that we've got on the panel, and it should result in a, hopefully very productive and thought-provoking discussion. But just before we start to contribute here, I thought it would be good to get you, the audience's sort of view on, I think one of the bullets, which I think was put out as the header for the in the header for the invites for this session, around basically turning trading desks, evolving from very asset specific trading desks into something that looks more like a truly multi-asset function, and whether the technology is fit for purpose to support that. So Amy, could we pop up the question, please, for our audience to answer? So folks, if you can read that question. There is pressure from both investment and cost perspectives for trading desks to become fully cross-asset. So by that I mean equity and FIC, fixed income, currencies and commodity. Do the current commercially available systems adequately support full cross-asset execution? And to avoid any prevarication or fence sitting, I've asked for just a binary agree or disagree. So if our audience could now sort of put their answers up there, do they agree with that statement or do they disagree? Okay, we're getting some answers in. Okay, and I think we're fairly static, but I think that's a fairly sort of solidly resounding disagree, saying that the technology is not really sort of at the moment, or the current state of the art of the technology is not sort of really fit for purpose for a true cross-asset trading function. So I guess moving on from that, before we get into, I think, some of the more sort of technical discussions, I think maybe there's an opportunity to talk about what, in terms of trading strategies, can we cross-fertilize best practice from different asset classes? So maybe taking some of the techniques that have been evolved in the equity markets and applying them to sort of fixed income bond trading, or vice versa. So I guess, Miguel, maybe as you're the practitioner of the actual, having to use these platforms and these processes, maybe you could open the answer to that particular question.
Sure. Thanks, Nick. I think it does depend on what one is trying to achieve, or the outcome one is trying to achieve with the trading. One of the things that's top of mind for us is definitely cost cutting, has been for the last few years. So we are doing more with less, if you will, right? I think when you think about what you're, in an over-the-counter market like fixed income, you're going through the pre-trade analysis, the relative value, you're going through a liquidity assessment, order prioritization, framing your price, knowing who to go to, how are you going to trade it, right? And I think some of the tools that we definitely are implementing are portfolio trading, and not just portfolio trading within bonds, but portfolio trading within mortgages, portfolio trading, and thinking about portfolio trading within muni bonds as well. And I think there's nuances and complications to each of those markets and how to do it. And I always get asked, well, when are you using a portfolio trade in corporate bonds? Well, I think it's really, again, dependent on your agenda, right? If it's a fund flow, you'll try to implement, it's easier to use a portfolio trade. But if you own, 30% of a bond issue, it's tough to kind of move a big agenda like that within a portfolio trade. But yeah, I think that's pretty much, some of the things that we're thinking about on the desk, and how we're trying to leverage technology to try to be able to scale, particularly for our systematic strategies.
Thanks, Miguel. So Mark, maybe, would you like to respond to that as provider of some of these technologies?
Yeah, I think we need to listen to what the traders are trying to do. They have a particularly challenging job as the markets become more and more electronic and these protocols become available. So I would certainly agree that portfolio trading is gathering steam. I'm hearing there are also new trading protocols emerging. For example, in North America in credit, there's a firm order book type trading, market access and other venues. And I think that, all-to-all trading has clearly become a feature of the market in the last few years as electronic markets grow. So I think these different protocols also have different purposes. We need to listen to what the traders need and be able to give them that capability. And the answer that we're bringing is to say, you really need to make those protocols available to the trader at their fingertips and give them the means to fully avail themselves of those capabilities. So bringing those protocols into their trading desk in a way that makes it readily accessible, and also integrating it with their data to help them become more efficient and effectively trade based on their experience in the markets, using their data proactively to guide their trading decisions.
Thanks, Mark. And I guess as we start to use different tools from different, which effectively have come up through different sort of strands of DNA, that must present some significant challenges as you take, shall we say, people who have always talked equity and then people who have always talked bonds and lived in sort of different ecosystems must present some significant challenges in terms of sort of integrating those platforms seamlessly. So I guess, Bill, as TradeWeb, that you must be very much at the sharp end of having to deal with those sort of integration challenges.
Yeah, most definitely, Nick. Thank you. And I kind of echo all the sentiments that have been said so far. It's been challenging. It's exciting. I think that's what we've been doing since we started, is just continuing to innovate, and doing so with a focus, more of a business focus. So start with that, and then kind of blend into technology. But thinking about what our end client, the traders themselves, is what they are trying to do. I mean, I think what we have helped in this respect is making them, or giving them access to liquidity and helping them transfer risk as efficiently as possible. And just thinking about that on a business level, portfolio trading is a perfect example. Something that we launched electronic trading of in credit and emerging markets starting back in 2019, but it's evolved since then. It's now, I think people are really gravitating towards it as a way to efficiently transfer risk and with very low leakage. So other examples of that, as TradeWeb, I think a lot of people looked at us and for a long time as simply, RFQ for U.S. Treasuries, request for quote, send an inquiry out to 5 counterparties, get quotes back, and then execute a trade. And it's been kind of exciting to see over the years how that has expanded, and how many different protocols we're bringing in. We're leveraging some of the tools that we've built on the wholesale market, as well as and bringing them into the institutional market, as well as taking some from the retail and bringing that, kind of marrying all these together. And it's different for every asset class, or every, it's not a one size fits all solution. If we look at something like U.S. Treasuries, where in the wholesale markets, people are used to having access to firm streaming liquidity, whereas in the institutional market, it's been more of an RFQ. But what we've tried to do there, as an example, is take the streaming firm liquidity from the wholesale market and give it access to the institutional market, the asset managers, in a form, something we refer to as stack, streaming actionable quotes. So that's an example of that, of how we're trying to navigate this and not build necessarily the better mousetrap just for the sake of it, but really focusing on that core mission of provide people with access to liquidity, giving them the data they need, to echo Mark's comments, and really, kind of move the ball forward and give them all the tools. From just to shift gears a little bit from the technology side of things, we do a lot of work in-house, because, obviously that's where our lies, but we definitely utilize the FIX protocol in spades, if you will, interacting with over 30 commercial vendors and 450 plus proprietary systems. So what we've, and that has a lot of challenges to itself. But what we've tried to do is kind of normalize the data so that if you're executing on TradeWeb you can use a common message protocol or common message format to get that order into TradeWeb, to get executions out, and building a lot of tools within our system to help make it as seamless as possible to give the traders the access and the efficiency that they need to really move the risk they want to move.
Thanks, Bill. Thanks for those thoughts. I guess just to pick up on something that Miguel said earlier on, in terms of, I think he phrased it, not just bonds, but sort of non-agency mortgages and munis and things like that. Maybe Miguel, you could comment on where you think the industry is at in dealing with the world that doesn't just look like a treasury or a bund or a completely vanilla piece of IG. As a consumer stroke user of these platforms, maybe you could just sort of express how developed or not you think the ecosystem is. And just to be clear, I'm not asking you to comment on TradeWeb or Axe Trading or anybody in particular, but just the general sort of ecosystem.
Yeah, I mean, I think.
Sorry, go ahead. Yeah.
Thanks. Thank you, Nick. I think I always think back to, I think it was probably right. I think it was 2011, and the running joke on the desk was always, "Oh, you're going to get algoed," And I remember, well, at that time, it's like, yeah, algoed. What does it mean? And I think it's hilarious when people use the term algo, because if you say algo to an equity guy, it's very different when you use the term algo for a fixed income guy. A fixed income person is thinking, some dynamic pricing engine, whereas, an algo in equity, they're thinking about, a scheduled base order release sent to, a different type of liquidity avenue. So within fixed income, I get asked the question, do I think it's going to go the way of equities? I do think it's going to potentially look like it, but I don't think without regulation, I think it's very difficult to get there. I think when you think about the different avenues of liquidity within fixed income, really being, the bank's balance sheet, the other side, the natural, or, all-to-all trading, I think it does help and lend itself to some techniques, strategies that you can use in equities, but I do think it's going to be very different. So one of the things that I face, or that my desk faces, is trying to figure out, which system to use. And you got to go through kind of this process that it's like, okay, I get the order. First of all, which asset class is it? Is it a solicited market or an unsolicited market? Now, is this a low touch or a high touch trade? Now, we don't have just one system we use. We do use TradeWeb. We do use others, competitors, other vendors. But we also use multiple internal in-house prop systems to try to really give you the information that you need to make the quickest decision possible on whether or not is it low touch, is it high touch? Are you going to RFQ this? Are you going to just go to one person? So I guess hopefully that addresses the question. But I think it's definitely very complex, because now you have what we call these dark pools, but they're not truly dark pools like you would in an equity world, because what the price is in equities, and you're always going to kind of cross that mid. Whereas in fixed income, no one really has an agreement in terms of what mid is, right? And so there's still this negotiation that happens between the two parties, right, that are involved. So as people get more comfortable with the technology and more comfortable around what I'd say even probably one of the more important things is a bond price reference index, right? For example, Bloomberg's BVAL or CEP Plus that MarketAxess provides. Getting comfortable around those, I think, will allow us to move forward from to a more people accepting more of the electronic side of execution for fixed income.
Yeah, I completely agree with you, Miguel. And I guess you've touched on to a certain extent that, if you like, the equification of what have been traditionally OTC markets, or pushing what have traditionally been OTC markets onto a process which looks in some ways more exchange-like, has been, I think, obviously one of the trends of the last sort of 20 years, some of it pushed by, shall we say, the natural evolution of the market, and some of it sort of less gently pushed by, the regulatory landscape and regulatory momentum. But I guess maybe to John, clearly, even within the equity market, there's very clear tiering of a liquidity from, the top end of the large cap stack to, what I understand is typically liquidity falls off even relatively quickly in large cap markets once you move away from the top 10 or 20 most actively traded names. So I guess when you're looking at building the tools and the data to support trading of the less liquid products, do you think those challenges will ever be resolved, or do you think this attempt to sort of push everything into an equity-like construct is at some point going to hit some irresolvable challenges?
Yeah, I mean, I started my career in equities and equity derivatives and moved to fixed income trading, and to just set the scene, the fixed income market, it's a $130 trillion market globally. It's actually 40% bigger, I was reading, than the global stock market. And yeah, I think on ESMA's last liquidity assessment of the 170,000 bonds tradable in Europe, 650 were liquid. It's like 0.4% of the population. So clearly we've got different liquidity paradigms between the two sectors. I think the challenges we've got coming to it's a horrible word to pronounce actually, the equification, I guess, of fixed income markets. If you look about commoditizing the workflows, it puts pressure on, I think, in particular EMS vendors. Getting to the original point, as you have multi-asset trading desks and roll out a multi-asset OMS, you need highly functional EMS platforms to service that low latency FI component, as well as the harder to trade blocks. And that the distinction, I think, between OMS and EMS gets blurred and the functionality intertwined as you start rolling that out. But I think as well in fixed income electronification, it's not just about electronic trading. It's automation of liquidity sourcing, aggregation, pricing, auto quoting, pre-trade liquidity tools. These are actually, I think, some of the biggest problems in the market, especially pre-trade TCA into a fragmented market. So, are we going to resolve these things? I think you look at infrastructure solutions in the market. I think players coming together, and we've seen it over the past few years in the primary and secondary space. I think you probably have to look at consolidation of some vendors in the market longer term, which starts sort of socializing some of these protocols out. You look structurally at maybe growth of some of the non-bank electronic liquidity providers in the FI space to kind of drive some of the innovation. But I guess when we talk about equity versus FI, the one area I find really interesting is on ETFs. And I think and we've touched upon it with portfolio trading. And if we look back to March last year, the beginning of the crisis, especially fixed income ETFs. So I think in March, when they traded about $700 billion in the market, they traded fairly painlessly, but there was a 5% NAV dislocation and no bonds were trading in the underlying market. So it's quite ironic. You can have something referenced to a fixed income composite index and the components still trading in a very fragmented way. So I guess I'll put that out there. There is something around the portfolio and the ETF part of the market I find quite fascinating.
Yeah, obviously having worked for a firm that does a few ETFs, I from my take has always been that's one of the advantages of those products, in that if you like, the cost of the liquidity premium, like I want to trade access, or I want to get access to that type of liquidity now, and the price I'm willing to pay for it is the fact that there will be some deviation from NAV, is kind of, well, that's the cost of getting access quickly, versus trying to trade the underlying basket myself slowly, bit by bit. Yeah, I will get there, if you like, in a stressed environment. I would get there more cheaply, but it's going to take me a lot longer, and the actual market moves may have been much more significant than my additional T costs. But that is always the challenge with that divergence. But just going back to what you said earlier, I think, part of the digitization of fixed income markets, which is a slightly more pleasant word than equification, is sort of, to my mind, always split into sort of two parts. On the one side, you've got the pipes and plumbing, the access to venues, trading platforms, ECNs, whatever you call them. But on the other side, a big part of it is providing the data around your trading environment, whether that's pre-trade reference prices, augmented data to facilitate post-trade TCA or whatever. But a lot of the challenge around digitization is really around the data rather than just the pipes and plumbing. And I know, Mark, you sort of commented earlier on that, or you alluded to that earlier. Would you like to sort of expand upon those thoughts?
Yes, thank you, Nick. I think this is a critical point. When you look at what's happening in fixed income markets, and Miguel was alluding to it earlier, you want to be able to make some of the processes more efficient so that you can scale your business or deal with the more complex trades more proactively. And that automation is underpinned by the right technologies, fit for purpose technologies, which can bring in all of these different workflows, put them at the disposal of the trader into a single application. And evolve with the markets. But it also is driven by the quality and the ability to use the data. So this data underpins, for example, we just talked about pricing, being able to determine, what's the right reference price to pre-evaluate a trade, or to measure whether it's the right time to trade, or what is the benchmark you use. And we've taken the view that it's very hard often to get agreement even between the front office trading desk and the portfolio managers around what really is the market pricing. So we've equipped traders with the tools to effectively use dealer grade pricing engine inside the EMS part, the QEMS that we provide, so that they can synthesize all of this information and use it to really achieve a real composite level that they feel is reflective of where they can trade, and share that with the portfolio management team. But beyond that, you've got other data like the transactional data. You've got data that's being made available by the venues, by specialist data providers, liquidity metrics and so on. And you need to bring all of this together as well. And then around that, once the data is reliable, you can build trustworthy automation. You can build rules-based automation that you can rely on to get that part of your business done that you're comfortable with. And as long as you can control it and trust it, but you're going to need the quality of the data to be good enough to do that, then you can get focused on the things that are really more high value, high touch, if you like. And given the complexity of the fixed income markets that we've just been talking about, that data really underpins this whole process. So that's how we look at the importance, the rising importance of data in this whole trading workflow.
I mean, obviously, Bill, I mean, your platform for a long time has had a very capable auto execution function for treasuries and other various, the top end of the liquidity stack in government bonds. I guess, one of the challenges around when you move out of that very top end of the liquidity stack is the opacity of the data. So I guess, John, I mean, you obviously sit in part of a firm which has every day I wouldn't, want to guess how many terabytes or zettabytes or whatever of data that you manage. And as consumers, we all know that data is out there. The problem is getting it piped into us in a way that we can digest, in scrubbed enough, clean enough, whatever, and sanitized enough that we can actually do something in-house with it, with the resources that a typical asset manager has, or even a large asset manager like my former employers had. So I guess, John, where do you think the industry is in terms of figuring out how to take that that huge ocean of data you've got and being able to direct it, the parts people want, to the right consumers?
Yeah, I mean, it's a good question. I think if you kind of look at the backdrop of how we've got here, that the whole fixed income market is being built on bilateral relationships and trust, right? I mean, that's the genesis of what we're operating in. And I think the challenge is, for whether you're on the buy side or sell side, is actually getting access to the data in the first place, which sounds easy, but it isn't. And I think certainly price makers and venues, they see value in streaming their prices via a mediated service. There's hunger in Europe, I think, when you just look at data availability, and people looked at MiFID, I think, right at the inception and thought this could be interesting, but arguably I say it's been a miss in terms of data and transparency. And we could have another chat about consolidated tapes. And if we look stateside, certainly I think, TRACE isn't perfect. And, if you look at MiFID and TRACE, are they fulfilling the needs of more algo and automated based trading? They're probably not, to be honest. So I think given the approach so far has been around developing private micro networks of data in the D2C space, there's still this gap and the need to almost industrialize it. It doesn't address the fragmentation problem, I think, as to how things are executed. And you're seeing trends, say some of the large asset managers are moving from GUI to API solutions for bilateral access messaging and execution. But I think where I kind of see the future in terms of data and that socialization of it, I think is probably more around, if you have a look in the IG space and credit, for example, for small electronic orders being pushed out to multiple dealers and comp, I think we'll have an increasingly transparent data environment because it's less painful as well for the risk takers in that space. I think when you get to the less liquid part of the trading spectrum and the bigger block sizes, that naturally gets served to, voice or non-comp dark pool trading or semi-lit matching sessions. So I think, long story short, to get back to your question, in terms of how you service that, you need to look at the liquidity profile of the market you're looking at. And I think it's probably best served to socialize that in, the IG part of the market, for example, in credit. Hopefully you can hear me. Someone said my mic volume was a bit low.
Loud and clear. Thank you, John. Yeah, loud and clear. Yes, no, that's interesting. So I guess before we sort of move on to, I think we've got another polling question, and then we open the mics to the audience to see what questions they have. But in terms of what's been discussed so far, oh, there goes the polling question. So the audience can think of that now whilst we just get the chance. In terms of what we've spoken about so far, has anybody got any other comments or things they'd like to say with in terms of the points which have already been brought up? Okay, so I thought we'd sort of, as we draw towards the end of the session, just put out something a bit provocative. And the question is, are we asking the wrong question? Will we see the rise in outsourced execution services that will invest heavily in their own data and technology and provide an execution package to asset managers and owners? So Miguel, obviously not an optimistic scenario from your perspective. And, we're well aware that a number of businesses, both sort of buy-side brokers and banks, have or are attempting to provide sort of outsourced execution services. I'd just be interested, I think, to see from the audience whether they think, those will succeed, or whether there will always be an absolute need for asset managers to maintain their own execution teams. So if folks can answer that question now, that would be great. And we'll see if we get some kind of responses. That's interesting. Yeah, that's interesting. I would have thought the answer would have been sort of more 50-50, or there may have been more disagreement, but it's kind of interesting that people see that there will be more of a move towards, I guess, outsourced execution. And I guess that one of the challenges for me for this is that when I've spoken to sort of asset managers about this, they can say, well, I can envisage an environment where, okay, my small treasury tickets and my small FX tickets and whatever, maybe, yeah, we do outsource those. But given that asset managers typically don't have teams of hundreds of traders, they have teams of at most tens of traders, does that outsourcing actually provide any commercial benefits for them or not? You can't fire, a tenth of a trader who spends 90% of his time doing high touch and then only 10% of his time doing the stuff you want to outsource. So I think that's kind of the challenge for asset managers. It's sort of a function of the scale of a typical asset management hedge fund execution team. It's, as I say, at most tens of people, not hundreds of people. So again, Miguel, again, as the practitioner, do you have any comment on that?
I definitely have seen more, I guess, headlines of outsourced desks potentially opening up. But I think what you run into is, you touched on it. It's really the breakdown. How much time is someone really spending on low touch versus high touch. And then you also have this conflict of interest, really, as a fiduciary to our clients. We want to get as much liquidity as we want for our portfolios, which we still cannot get, 100% fill rates on what we're trying to do, right? So you add that and layer in liability, with trade errors and whatnot, and also getting comfortable around having that data and how that data is shared by your outsourced desk or how it's used. I think there's still a lot of hurdles. I actually envision more investment into, the automation of that low touch, right? Whether it be RFQ, auto execution, and leveraging technology and tools that allow you to ideally, I always joke with my brother, to trade at the speed of thought, right? An outsourced desk could potentially use the same outdated kind of strategies or protocols, right? I think it's the focus on the technology and the focus on, automated and rules-based trading for fixed income will be the winner of the two. But, time will tell.
Thanks, Miguel. Does anybody else have any comments on that?
I would have to jump in there and agree with Miguel's comments. I mean, that's what we've been seeing and we've been focusing on for a while. And you alluded to it earlier, Nick, that kind of automation of rules-based trading in fixed income. It's an interesting space where it started with just the automation of low touch, kind of dealing with the kind of 90 or 80-20 rule, however you want to say, with what's adding alpha and what's just keeping the lights on. So the tools were originally developed, simple, take care of the small treasury orders. But over time, it's evolved and it's become more of an alpha generator for clients. And we've had to keep up with that with the input of our clients. What started as just a simple, kind of 10-line rule to execute a treasury on an RFQ basis has now, kind of snowballed across many product asset classes, has, kind of 100 plus rules that you can implement, and based on different liquidity profiles, back to, what we were talking about earlier. So you can set up rules for IG trades, rules for high yield trades, different marketplaces, different profiles of the order. So I think the whole market is moving towards that. But what we're doing is trying to work with a lot of our asset manager clients to really develop those tools and give them what they're asking for. And it sounds like, what Miguel, at least specifically, is asking for. So I'll try to keep up with what you need.
Thanks, Bill. We've got a couple of questions from the audience. So I guess we've got a few minutes left, so quickly rattling through. One, our favorite attendee, anonymous attendee, is asking, should buy side source that OMS and EMS from the same provider or keep providers separate? Is it best to build or buy EMS? Mark, maybe just very briefly, could you field that question?
Yes, with pleasure, Nick. I think our answer would be, it really depends on what you're trying to achieve as a firm. But I think our experience shows, when you look at just what we've been discussing in terms of the challenges around fixed income, the trading venues themselves are innovating and bringing new trading protocols to bear. There are new sources of data, the workflow automation. This requires constant ongoing investment, and the costs are not insignificant. So if you want to build a specialist built for purpose solution yourselves, how much of a differentiator is that going to be for your business versus what you could achieve with something that you buy and then customize off the market? The next angle to your question, I think, comes from whether the OMS and EMS should be from the same or separate providers. Again, I'm obviously, one could argue I'm biased, but I think our experience shows that it's very difficult for a generalist to keep the necessary focus and evolution speed required to keep their functionality and their capabilities up to speed with the way the markets are evolving. So you could just look to the providers that are out there in terms of order management systems and ask yourself whether they truly satisfy the full needs of the trading desk. We argue, therefore, that you really do need to separate those two. And that's been the case in other markets as well. So I hope that answers the question, but I'm happy to clarify further explanation.
That's great, Mark. Thanks. We have a sort of live question. I know we have quite a number of questions, but we'll just jump to a live question from Tom Jordan, I believe. If Amy, you can unmute him so he can ask his question to the panel.
Sure. Can you hear me, Nick?
Yeah, that's great, Tom.
Perfect. Okay. Miguel at the beginning talked. My question has to do with regulation. How will regulation change this market? Miguel referred to it at the beginning, so I'd like to hear what people feel about that. And then more specifically, Bill, the FINRA rule, the new proposal on Treasury of making it order in terms of who will be reporting and how quickly you have to report it. So if we can talk about regulation and how it will affect the market, I appreciate it.
Thanks, Tom. And actually, there's another question on the list being contributed on the chat, asking about vendors being regulated as MTFs and whether that will stunt innovation due to the additional regulatory overhead. So maybe they can be rolled on together. I guess, Bill, you're the sort of obvious person to field those.
I'll start off, and I'm going to pick and choose. Tom, thanks for asking the question, and the anonymous questions always keeps the conversation going. I like it. I won't comment on the specific regulation that Tom mentioned. I don't know enough about it myself personally. I can speak to kind of what we've done as a firm to help clients. I don't know if the right keep in line with regulation and what we've had to do, and we've made a lot of investments in ensuring that the trades are executed in a certain way, and whether it's MiFID II or whether it was Dodd-Frank and the advent of CEF, helping to clients to do trace reporting. There's a lot of things that we're doing, or even looking at Brexit as a quasi-regulatory kind of paradigm. As a trading venue, we have to ensure, and as a regulated venue, we have to ensure that we are keeping abreast of all these rules and keeping in line and I think one of the things that we do is use this regulation as an opportunity because we partner with our clients to ensure that when they do and execute a trade on the TradeWeb system, that they are guaranteed to ensure they are in compliance with all of the various regulations. And we have a specialist team who kind of keeps their eye on the various regulations. As I allude to, because I don't know all the regulations myself and what's coming down the pipeline, I defer to their expertise. But then we sit with our clients, we sit with our partners, and talk about things like workflows and message structure and data requirements, and really come up with the solution that is going to be a best fit for all parties involved. So it's definitely a front of mind issue, regulation on any given day.
Great, thanks, Bill. And I guess we got an excellent question from Nicolas Piloget. I hope I pronounced that properly. He's asking any thoughts on the primary issue market and technology solutions out there to improve workflow and efficiencies in primary markets. Maybe John, you can field that.
Yeah, I think, obviously there have been some moves in that space over the past few years with a couple of initiatives so that the primary dealers have brought together there. I think it's certainly long overdue, put it that way. I think it's kind of an interesting fit to our conversation around fragmentation of electronic secondary markets, because actually if you look at primary, it's not so much a fragmented market problem, it's more a workflow problem actually. So we're solving different things within the primary space versus the secondary space, and it's kind of around having that transparency of comms, socializing data, T's and C's, and book build requirements Whereas in secondary, we've got a market fragmentation issue, and data and disclosure and pre-trade TCA is a completely different problem set. So I actually think the primary market problem is a lot easier to solve than the secondary one, which, you know, as part of the preamble in this conversation, we can see there's no easy solution to that fragmentation in secondary. We've got multiple protocols. We don't have fantastic pre-trade TCA pricing disclosure, multiple venues, multiple avenues of regulatory issues coming up. I can see on the chat, you've got a couple of questions. I think actually the primary workflow problem is actually an easier problem set to solve.
Thanks, John. And I guess just, I think we've probably got time just for sort of one more question. So I'll try and sort of summarize a couple of questions that have been posted around the outsourced trading idea. And the comment is generally sort of the experience of, you know, if you're at somewhere like a BlackRock, where Miguel and I have worked, American Century, PIMCO, wherever, a large firm, your experience of accessing liquidity is going to be very different to if you're at a smaller firm. Does that drive or push the drive towards more outsourced execution to be sort of more attractive for a smaller firm potentially? I guess, Miguel, what are your thoughts on that?
I think that's a great point, right? If I'm a smaller asset manager or hedge fund, you know, it's really just going to come down to cost, right? The cost, and also assuming that liability, but and also feeling comfortable with who you're outsourcing it to, in terms of, like, again, I think I mentioned how they're going to use your data. Are you going to be treated fairly, you know, with regards to maybe other clients? And all of that is, you know, that's relationship based. So it's difficult to, it takes time for it to build. But yeah, with respect to that concern, sure, it's very different. Having traded at BlackRock, you know, there is a BlackRock price. Having traded now, or, you know, my current firm, where I'm keeping things more cash balanced in terms of the worrying about cash, right? The overdraft accounts. That's actually now a real concern of mine. So there, and it brings the idea of like tiered pricing right now, and it goes back to, okay, with the data that I'm receiving, and am I receiving the gold price or the bronze price, or, you know, so, you know, it kind of all ties together. But yeah, I agree. Look, it's really dependent on the client. I don't think the large asset managers necessarily would require the outsourced trading, but, you know, without a doubt, look, in equities, I know when I was doing equities earlier in my career, there's a huge business for outsourced equity trading, right? The other thing I'd like to touch on, and I just want to mention with regards to the regulation that I mentioned earlier on, what I was referring to is for bonds to look more like equities. With, for example, when I'm trading equities, you know, you have Reg NMS or the National NBBO, Best Bidder Offer. As a retail investor or as an investor, you're protected in always achieving the best price. In fixed income, there is no regulation on that front, right? I can go and get picked off buying something at a bad price, which requires a little, you know, more work with regards to being able to understand, you know, or get metrics like an ADV. How much does this bond trade? You know, you're estimating, you know, given trace volumes, which they themselves are estimates and not full trade sizes that are disclosed. But that's what I was regard to, protecting the investor when interacting in these markets, so that it's a standard interaction. Yeah, and that's it for me. Hopefully that answers the questions.
Okay, Miguel, thanks very much. Folks, thanks very much for your contribution. Miguel, John, Bill, Mark. I think it's been a sort of really interesting session, really interesting topics being discussed. I think we've managed to get through most, but not all of the questions. I think the FIX organizers, Naomi, will take a look, and any questions which we didn't manage to have time to get to, we'll attempt to answer sort of offline. But thanks very much, everybody, all my panelists, for participating, and thanks to the FIX community for joining us on this session. I hope you found it as interesting as we did. Thanks.
Thank you.
Great. Thanks, Nick. And thanks everybody, all the other panelists, for participating, providing perspective on this topic. We're just going to run through a couple of things to close out this session. In addition to maintaining and extending the FIX protocol, de facto standard for electronic trading, FIX provides a platform for members to discuss a wide array of topics. And on this page, you can see a number of groups that we have running right now. Consolidated Tape, we have a fixed income and equities subgroup focused there. Our cybersecurity working group recently published an update to the FIX-S technical standard, specifies how to use the transport layer security protocol with FIX, and this is available on the website. Our digital asset working group is working in this constantly evolving environment and finalizing recommended practice for the transaction of digital assets for the buy side to sell side. We have an ESG working group that's going to see how FIX can provide support for ESG reporting. The ETF working group will standardize and simplify the ETF full life cycle from creation to redemption. FIX ATDL just recently, 10 years later, published an updated version of the FIX ATDL version 1.2, and this addresses additional features and challenges identified for the community. So again, this is available to download on the website. The Orchestra Working Group, FIX Orchestra is emerging technology, turns rules of engagement to actionable data. They've also created a log to Orchestra tool, which is available on the FIX website for member firms, and it converts standard FIX engine log files to an Orchestra repository. We've also have a MOST working group, and they're looking to improve quality and efficiency of platforms, decrease the time to market by exploring, monitoring, onboarding, and software testing. And actually, this call is happening at 11 o'clock. So if you have some time, you can join that call. Post-trade working group, working to further down the post-trade chain, addressing netting and settlement instructions. And our SEC lending working group is developing standards of securities lending messages, and the initial scope will be post-trading clearing. And now these are just a couple of our groups. We have a lot more that you can get involved in. And if you're interested, just contact the program office at fix@fixtrading.org. The next slide that Naomi's going to show are the upcoming events within the fixed trading community. We have global events. Many of these are still going to be, on the web, but following this one in the Americas, following this fixed income one, we'll have an equities evolution of OMS EMS, and we'll be building out further series after that. June 23rd is the EMEA Trading Conference. This is a virtual event, and it's live and open for you to get your tickets, so please register today on the events page. November 18th, we'll have the Nordic Trading Briefing. And then in the Asia Pac region, going into the third and fourth quarter, we have series of 4 different events going on, and you can check out more on the events website page there. And then also you'll receive a survey just to help us sort of curate our events and what we could deliver to the industry and what's important to them. So if you can grab that QR code as it's on the screen right now, that's great. If not, it will be emailed to you, a link to the survey, and we would appreciate your participation so we could serve you better. And then finally, I'd just like to again thank Axe Trading for sponsoring our webinar today, and for everybody who took the time out of their day to join. Have a great day. Take care, everybody.